Hello and welcome to this webinar. This webinar is number 6 in the Housing Industry Association series of webinars related to the JobKeeper payment stimulus measure provided by the federal government in response to COVID-19. This webinar will focus on the JobKeeper payment, record keeping and reporting requirements for a business that is eligible for the JobKeeper payment. Today, we will provide a refresh on what the JobKeeper payment is, and will also outline how you can apply for the payment. Please note, HIA has developed a series of fact sheets and webinars on the JobKeeper payment to assist our members to understand these requirements. We understand the whole process can be complex and would like to remind members requiring assistance, you can contact HIA's Workplace Services team on 1300 650 620. So what is the JobKeeper payment? Just a bit of a recap. Becoming eligible for the JobKeeper payment means two things. Firstly, as an employer, you will be eligible for a wage subsidy of $1,500 before tax per fortnight per employee for up to 6 months. PayYG is payable on the amount. The payment of superannuation will depend on whether the employee's usual wage is more or less than the $1,500. For more information, we suggest you see the HIA JobKeeper information sheet number 4, receiving the payment. Secondly, once eligible, an employer can give eligible employees directions in relation to hours of work and annual leave. These working arrangement directions are explained further in other information sheets on our website. The objective of the JobKeeper payment is to support employers maintain a connection with their employees and to enable businesses to reactivate their operation quickly without having to rehire staff when the crisis is over. So what are the record keeping requirements? To be eligible for the JobKeeper payment, a business or entity must keep records of its GST turnover, its eligible employees, and any JobKeeper enabling directions issued by the employer. Each of these record keeping requirements will be detailed over the next several slides. Firstly, we will recap on what the turnover test is about. To be eligible for the JobKeeper payments, the entity or business must satisfy the turnover test. The turnover test can be satisfied in two ways: the basic test or the alternative test. Generally, businesses will use the basic test, which is based on GST turnover and generally a decline of 30%. An employer will be eligible to claim the JobKeeper payment on behalf of their employees if they have a turnover of less than 1 billion and the turnover has or will be reduced by more than 30% relative to a comparable period a year ago of at least a month at any time between 30th of March 2020 and 27th of September 2020. For example, you will be immediately eligible if your March 2020 turnover has reduced by 30% compared to your March 2019 turnover, or you will become eligible in June 2020 if your turnover has reduced by 30% when compared to your June 2019 turnover. Employers with a turnover of 1 billion or more are also eligible if your turnover will be reduced by more than 50% relative to a comparable period a year ago of at least a month. The turnover test period must be a calendar month that ends after 30th of March 2020 and before 1st of October 2020, or a quarter that starts on 1st of April 2020 or 1st of July 2020. Sometimes a business may not be able to satisfy the basic test, or it may not be appropriate. For example, where the business is a new startup and does not have an appropriate, relevant comparison period in 2019. In these cases, the Commissioner has determined alternative tests for fall in turnover for classes of entities where there is not an appropriate relevant comparison period in 2019 for the purposes of an entity in the class of entities satisfying the basic test. It is important to note that the alternative test will only apply to 7 circumstances, and each of the 7 circumstances has its own alternative test. We will now look at the record-keeping requirements for the turnover test. As previously stated, to be eligible for the JobKeeper payment, the entity must satisfy the turnover test, either the basic test or alternative test. Once an application for the JobKeeper payment has been made and accepted by the ATO, there is no ongoing requirement for the business to comply with the turnover test. However, there are monthly reporting requirements. An eligible employer must notify the ATO of its current GST turnover for the reporting month and its projected GST turnover for the following month. It should be noted that this is not a retest of your eligibility, but rather an indication of how your business is progressing under the JobKeeper payment scheme. The report must be made in the approved form within 7 days of the end of the reporting month. To do this, you may need to log into the ATO online services through MyGov or the business portal using MyGov ID. This step may also be completed through a registered tax or BAS agent. We will now go through the record-keeping requirements for eligible employees. So, in addition to having to keep records for the monthly reporting requirements, a business must also provide information about eligible employees to the ATO. In order to collect this information, the employer must send the JobKeeper employee nomination notice to all nominated employees for the scheme to complete and return to you. If you plan to claim for JobKeeper fortnights in April and May, this must be filled out by 31st of May and kept on file. If nothing changes regarding your eligible employees, you do not need to provide this information again. Employers receiving the JobKeeper payments are required to retain records to allow any information provided to the Tax Commissioner to be verified for 5 years after it is provided in relation to a payment. We will now turn to the record-keeping requirements for the job enabling directions. So once your business and employees are both deemed eligible, the JobKeeper scheme will provide employers with access to a range of measures to temporarily provide greater flexibility in relation to hours of work, which are called JobKeeper enabling directions. It also allows greater flexibility in the taking of annual leave. A JobKeeper enabling direction provides eligible employers with the ability to issue a JobKeeper enabling stand-down direction or make changes to hours of work, the performance of duties, and the location of work. It is important to note that the JobKeeper enabling directions are only available in circumstances where both an employer and employee are eligible. For example, a JobKeeper enabling direction could not be made by an employer who may be deemed eligible to an employee who is not deemed eligible because they were first employed after 1st of March 2020, or if circumstances where an employee is taking paid or unpaid leave that is authorized by the employer, or during times where they are otherwise authorized to be absent from employment. Once an employer issues a JobKeeper payment enabling direction for stand down or change of hours of work or location, They must keep records of the consultation that was carried out with the eligible employees about the proposed direction and the direction provided. The records may be in the form of emails, file notes, or meetings, which evidence consideration of the employee's views. What happens if you don't keep records? Well, there are penalties that the ATO can issue. An anti-avoidance scheme will arise if an entity, in effect, enters into an arrangement under which it receives a JobKeeper payment, which, but for the arrangement, it would not receive. More generally, employers who do not comply with their obligations tied to the JobKeeper payment can be liable for a wide range of significant sanctions. As you can see, substantial penalties apply if convicted of an offence. Administrative penalties for making a false and misleading statement. The penalty is a financial penalty of up to 75% of the amount of any overpayment. Criminal offences for making false or misleading statements to taxation officers. Imprisonment for up to 12 months and a fine of up to $10,500 for an individual and $52,500 for companies. Failure to comply with the requirements under taxation law, imprisonment for up to 12 months and a fine of up to $10,500 for an individual and $52,500 for companies. Obtaining financial advantage, imprisonment for up to 12 months, obtaining financial advantage by deception, imprisonment for up to 10 years, conspiracy to defraud, imprisonment for up to 10 years. This webinar concludes HIA's webinar series on the JobKeeper payment, and thank you for watching. Remember, you can always go back and rewatch any of HIA's webinar videos on the JobKeeper payment. We understand that the process can be complex, and members requiring assistance are encouraged to contact HIA's Workplace Services team by calling 1300 650 620. Alternatively, you can email inquiry@hia.com.au. Thank you for your time.